All right, welcome back. Today, we are going way beyond the basics. You know that feeling when you draw a perfect-looking supply or demand zone, and then you just watch the price blow right through it? Yeah, if that's you, then you are in the right place. We're going to break down 5 advanced secrets that really separate the pros from everyone else. Okay, let's dive in.
And this is the core of the problem, isn't it? You draw a box on your chart, you hope for the best, and you kind of cross your fingers and pray that it holds. It just feels so random. But for professional traders, it's not a guessing game at all. It's a game of probabilities. They aren't hoping, they are following a very clear set of rules.
And that's the million-dollar question, right? What are they seeing that most of us are missing? Well, it turns out there are these clear, identifiable patterns and contexts that just drastically shift the odds in their favor. So here's our game plan. We're going to pull back the curtain. We'll start with the classic trap that almost everyone falls into. Then we'll get into the good stuff, 5 powerful secrets. We're talking about following the flow, why higher time frames are king, how to tell a real break from a fake one, spotting the sneaky compression trap, and finally how to trade the extremes. Okay, let's kick things off with the biggest mistake of all, the retail trader's trap. This is that habit of just drawing a zone and hoping it works, all while completely ignoring the bigger picture, the market context. So that brings us to our very first secret. You have to learn to follow the order flow. Now, this isn't some magic indicator. It's simply about aligning your trades with the smart money, the big institutions that are actually moving the market.
Look, order flow sounds complex, but it's really not. It's just the dominant direction of the market. You can see it right there on your chart. If you're in a downtrend, price is making lower lows and lower highs. Simple. That tells you supply is in control. And in an uptrend, it's the opposite. Higher highs and higher lows, meaning demand is in charge. You don't have to guess what the big players are doing. They literally leave footprints.
Think about it this way. If the market is clearly falling, trying to buy at a demand zone is like trying to swim up a waterfall. It's a super low probability bet. The professional, on the other hand, waits for the price to pull back up to a supply zone and then sells, moving with the current. The biggest takeaway here? Just stop swimming against the tide. And the difference this makes is just staggering. According to our source, zones that actually line up with the order flow have a 5 times greater chance of working out. 5 times. Just letting that one fact sink in can totally transform your trading results.
Next up, secret number 2. And this is a big one. It's a mistake that even really good traders can make. Completely ignoring the big picture. Because in trading, you have to remember, higher time frames always rule. So, imagine this. You're zoomed in on a 15-minute chart. The structure just flipped bullish, a beautiful demand zone formed. It looks like a textbook, picture-perfect long entry. You're feeling confident, you place your buy order, and then bam! Price just smashes right through it. So what happened? It's because you forgot to ask this one simple question. You were so focused on the tiny little waves on the 15-minute chart that you didn't see the giant tsunami that was forming on the horizon. What was actually happening on the 4-hour chart? This is where top-down analysis becomes your best friend. A pro would have immediately seen that your bullish shift on the 15-minute was really just a tiny pullback into a massive 4-hour supply zone. The primary trend was still bearish. That little 15-minute demand zone, it never even stood a chance. You can't confuse a small pullback with a major trend reversal.
Okay, on to secret number 3. This one solves a huge mystery that drives traders crazy. Why do 2 zones that look almost identical perform so differently? Well, the answer is that not all breaks of structure are created equal. So here's the difference. A low priority zone, that's the weak stuff. It's formed after breaking some minor internal piece of structure on a really low time frame, like the 1-minute chart. It's basically just market noise. But a high priority zone, that's the one you want to trade. That's a zone that causes a break of a major swing high or low on a much higher time frame like the 1-hour or the 4-hour. Now that is a meaningful shift in the market. So from this day forward, before you even think about trading a zone, ask yourself this simple question. Did this zone cause a truly significant break of structure on a higher time frame? If the answer's no, it's probably a trap. If it's yes, then you've just found a high probability spot to look for a trade. Now for a really sneaky one, the compression trap. This is how smart money engineers liquidity. They basically trick retail traders into getting stopped out right before the real move they were waiting for happens. It is so frustrating and it happens all the time. Let's walk through how they do it. So, Price slowly, choppily grinds its way up toward your supply zone. This slow, grinding price action tricks traders into thinking the zone is definitely going to hold, so they start selling early. Then all of a sudden, price spikes up just past the zone, taking out all of their stop losses. That's the liquidity sweep. And only then, after all those early sellers are out of the market, does the real drop begin. Smart money just used their stop losses as fuel for its move. The big takeaway here is you have to be super wary of that slow, grinding price action. Like the quote says, the best reactions, the ones you actually want to be a part of, they're impulsive. If price is hesitating and grinding as it approaches your zone, a trap is very likely being set.
And finally, secret number 5. This gives us a crystal clear set of rules for one of the most dangerous market environments out there, consolidation, or, a sideways range. Most traders just get chopped to pieces in here, but the pros know exactly where the real opportunity is. The easiest way to think of a trading range is to break it into 3 parts. You've got the top 30%, that's your premium area where you look for sells. You've got the bottom 30%, which is your discount area for buys. And that big 40% chunk right in the middle, that's the danger zone. It's pure indecision and you should avoid it like the plague.
And the rules for this are so simple and mechanical. First, you just identify the high and the low of the range. Then, you can use a tool like a Fibonacci to mark out your premium and discount zones. And then you just wait. You only take trades from the absolute extreme edges of the range. That middle part is just a battlefield where retail traders are providing liquidity for the institutions who are building their big positions at the edges. So, let's recap the 5 secrets that can seriously transform your trading. Number 1, always trade with the institutional order flow, never against it. 2, start your analysis from the top down, because the higher time frames always win. 3, only trust zones that cause a meaningful break of structure. 4, recognize that compression is a huge red flag for a potential liquidity trap. And 5, when you're in a range, trade the extreme edges and avoid the middle at all costs. And all of this leaves us with one last really important question you need to ask yourself. After seeing these rules, are you truly analyzing the market with a clear process, or have you just been treating it like a guessing game? You see, adopting these secrets is the first real step toward trading like a professional. That's all for this explainer. Thanks for watching.